DSCR loans have exploded over the last few years, but where are they headed next? Will they get cheaper? Will more lenders jump in? Will we start seeing DSCR loans for bigger properties or short-term rentals? That's exactly what I'm going to be breaking down today. The future of DSCR loans, what's changing, what's coming, and how it impacts you as an investor. Hi guys, my name is Ivan Simmental. I'm the broker owner of The Mortgage Standard, and I've been in the mortgage business for over 12 years now, and I help investors and families make smarter moves with financing. And I'm telling you right now, DSCR loans are going to look very, very different in the next few years. If you're an investor, you need to know where this market is headed, because the decision that you make today, it can impact your portfolio in the next year, in the next 6 months, 2 years, 3 years. It can impact your portfolio. Currently, DSCR loans are labeled or categorized as a non-qualified mortgage or a non-QM loan. That just means that they don't use your W-2s, tax returns, or personal income to qualify. Instead, they're based on the property's cash flow. The future, I see DSCR loans becoming more mainstream. And here's what that means. More lenders will offer them, not just specialized non-QM lenders or shops or whatever we want to call them. Standardized guidelines will make it easier for investors to shop around without the crazy differences between lenders. Agencies like Fannie and Freddie, or Fannie Mae and Freddie Mac, for those of you that want the full name, they may eventually adopt a version of a DSCR loan. Now, if that happens, the biggest change will be cost. Lower interest rates, smaller fees, and easier access. Now think about this. Right now, DSCR rates are higher than conventional rates because it's a non-QM loan. But if mainstream adopts these loans, investors will save big on financing costs, and that's going to attract even more demand because of that. Now today, most DSCR loans are written for 1 to 4 unit properties, single family homes, condos, duplexes, triplexes, and fourplexes. Some lenders will go up to 5 to 10 units, but that's very, very rare. I have personally never done one for that many units, if that makes sense. So what's in the future? We can expect DSCR loans to expand into larger multifamily assets. And here's why, or here's the breakdown from my opinion. 5 to 10 units. Right now, only a small pool of lenders allow this. Expect that pool to grow 10 to 15 units. As performance data proves DSCR loans are safe, lenders will loosen up their guidelines for these. 15 to 20 units, well, this could open the door for small apartment investors who don't qualify through traditional commercial channels. So if you're thinking bigger than fourplexes, this shift could open up a whole new path for financing. Now, in my opinion, I think it makes sense because as long as your rent covers your mortgage payment, that's what really matters, right? And if you have additional buffer, then that's even better for the lender that's giving you the money or that's lending you the money. So that's why I think that this is going to get adopted by more and more banks, right? So let's talk now about Airbnb and VRBO. So these are obviously the short-term rentals, and they're everywhere right now. Everybody's trying to get a loan for these, and they're not slowing down. Today, DSCR lenders already finance short-term rentals, but it's not always consistent. Some lenders use AirDNA data to project rental income. Others allow long-term rent comps. In the future, here's what I expect. Dedicated DSCR products designed specifically for short-term rentals. More lenders accepting STR income as valid, not just a handful of lenders. I think there's going to be better data integration. So underwriting decisions are based on real market performance, not just these estimates that some people give or that they shoot out based off of an algorithm. And so if you're running Airbnbs, this is a huge deal. Instead of fighting lenders on income numbers, you're actually going to have loan programs tailored for your specific model. Right now, figuring out DSCR income means using outside tools like Zillow or Rent-A-Meter. Underwriters then verify the comps. And so it takes time, of course, to verify everything. In the future, I think it's going to be driven by AI-driven underwriters. And here's what I think that looks like. Automated income analysis. So AI pulls historical rental comps and local performance instantly. That's going to make it have faster approvals. Instead of waiting 25 to 30 days. I think loans could close in about 15 to 20 days. So there's going to be less human error involved. So the more tech that handles these calculations, the fewer mistakes and slowdowns that this can cause during closings, right? So that means smoother deals for investors and faster fundings to get into properties quicker. One thing investors do not love about DSCR loans right now, those lovely prepayment penalties. So before we go on, how many of us know what a prepayment penalty is? Well, a prepayment penalty in the very simplest of terms is I'm going to give you this loan, but if you sell this property before having it for a year, 2 years, or 3 years, I'm going to penalize you for doing so. That's a prepayment penalty. They charge you a specific fee or a certain fee for selling, refinancing, or letting go of the property before the time frame that they allow you to do it. I hope that kind of makes sense. Now, most DSCR loans right now, their prepayment penalties, most of them are fixed, 3 to 5 years. I've seen 1, 2, 3, of course, years, but like I said, where you pay a penalty if you refinance or sell early, but that's already changing. Some lenders are now offering, I'll give you a penalty for year 1, 3%, year 2, 2%, year 3, 1%. As competition heats up, I think we should expect these penalties to continue to loosen up. And so that's good news because it means more flexibility to refinance or sell without being locked in so tight. And I think the scrutinization of this one's huge for me. This point is huge for me. Conventional loans are securitized, meaning they get bundled and sold on the secondary market. And that's what makes them liquid and keeps rates low. As DSCR loans gain traction, I believe the same thing will happen. There's going to be pools of DSCR loans that will be sold to investors. Investors' appetite for these types of loans will increase and that demand will push rates down, right? And so this could be the game changer that takes DSCR loans from a niche or a non-QM financing to a widely accessible, lower cost tool for everyday investors. Now, I've done countless of DSCR loans and they are fairly simple to do. It's almost shocking how easy they are to do. If the property makes sense, then you essentially have a loan. Right? If the property covers the rents, then you have a loan, assuming that you have the credit and the down payment, of course, but they're very, very easy to qualify for. So guys, let's wrap it up. Here's where DSCR loans are headed. They'll be becoming more mainstream and widely accepted. This is all my opinion, of course. They'll expand into larger asset classes. You'll have short-term rentals that will also get dedicated type products. Tech will make underwriting faster and easier. This is already happening, by the way. Prepayment penalties will loosen up, which is already happening. And the securitization will eventually push rates even lower. So if you're an investor, this is not just a theory. This is your roadmap. Now, if you want to stay ahead of the curve, hit that subscribe button and like right now, please, because I want to get this message out to more people. Turn on the notifications so that you don't miss any of my breakdowns on real estate and mortgage strategies. I drop videos every week to help you win in this market. And if you're ready to see how a DSCR loan could help you buy your next property, click the links below to apply or schedule a call or a conversation with me directly. I'd love to help you figure out a strategy that makes sense for you and to work together. Guys, I'm Ivan Simmental with the Mortgage Standard. Thanks again for watching, and I'll see you on the next one.